information, you are able to make adjustment. So this green color information is the adjustment, right? Revenue reversal. Very good. Okay. So no questions. I'm gonna move on. Oh, step 4. Finally, we are moving to step 4. Okay. Step 4 is about allocate the transaction price. Okay, allocate transaction price to performance obligations. So I'm going to speak for another maybe 10 to 15 minutes before we take a break. Is that okay? Yeah. Okay.
Yep.
So step 4 is about allocating the transaction price to performance obligations. Okay. So as much as possible, the reporting entity should use observable standalone selling price. Okay, when they are allocating the performance obligation. So what do you mean by the observable standalone selling price? Standalone selling price is the price at which an entity would sell a promised good or service separately to a customer. So I think most of you have this experience, right? When you are dealing with Shaw, with Rogers, Telus, right? Have a internet service. Sometimes they offer you a package, right? So that one contract, you can use internet. You have a home phone. You have like a cable, right? TV, right? So those contracts could have 3 performance obligations, right? Make sure your cell phone, make sure your internet run very well. Otherwise, you are not able to attend my lecture. Make sure your TV run very well. Maybe you like some sports channel, like me, NBA, right? Or you have to make sure your home phone runs well because you need to get in touch with people. So there are 3 performance obligations. So often they package this service together, and the total price will be a deal, right? They charge you less money than the total separate selling price, than the sum of the total separate selling price. So what do we mean by standalone selling price? If you only order TV, okay, how much they charge you? Okay, that is the standalone selling price for the TV service. If you only want the service of internet, how much you pay? That is the standalone selling price for the internet. Okay, does that make sense? Okay, however, sometimes this standalone selling price is not directly observable. You don't know this value. Okay, there are 3 alternative choices: adjusted market assessment approach, expected cost plus margin approach, and residual approach. So I'm going to focus on the residual approach. Okay, so if you are confused with this slide, don't worry. I'm going to give you more examples. Okay, so this is one example of the residual approach. So suppose one contract have 3 performance obligations, and the total transaction price is $900. Okay. Performance obligation 1, if you buy this service, it's going to cost you, if you only buy this service, okay, the standalone selling price is $500. If you only buy the performance obligation service number 2, that's going to cost you $300. So this 500, 300 are the standalone selling price, but you don't know what is the standalone selling price for the 3rd service. How are we going to allocate this? So under residual approach, okay, this is how you're going to do it. Okay, so you allocate 500 out of the 900 to number 1. You allocate 300 to number 2. And what's left? Right? You have allocated 800. So you're left with 100. So you're going to allocate 100 to performance 3. We call this approach residual approach. Any questions?
No.
No? Okay. Good. So that's the residual approach. Okay, suppose now, in a different scenario, 3 performance obligations, we know all the standalone selling price, okay? So 1, 2, 3, the standalone selling price are 500, 300, and 200 respectively. Okay, so the total, if you sum it up, okay, if you sum up the standalone selling prices, you get 500, 5 plus 3 plus 2, that's 10, right? You get $1,000. And usually they give you a deal, right? When you buy this service together, usually they give you a deal, so they will not charge you 1,000. Suppose they charge you 900, okay? How we should allocate the 900 to the 3 performance obligations?
Would it be proportional?
Yes,
Proportional.
Weighted average.
Very
Or
good.
weighted.
Very good. Proportional. Yeah. So here is what happening. So I'm going to first calculate the sum of the 3 standalone performance, the sum of the 3 standalone selling price. So that's going to be 500 plus 300 plus 200. So that's 1,000. And then I want to calculate each standalone selling price as a percentage of the total standalone selling prices. Okay. So for number 1, the proportion is 500 over 1,000. So I get 50%. So similar idea, 30%, 20%. Okay, so in total I have 100%. Next, in my allocation, I'm going to use the same proportion. Okay, I'm going to apply the proportion against the transaction price, which is the $900. So for performance 1 is 50%, I will get half of 900, which is 450. For number 2, 30%, I get 270. For number 3, 20%, I get 180. And the total is 900. Okay, so let's use a pie chart. Okay, so basically, if you only consider the standalone selling price, this is the pie chart, 5, 3, 2. In total is 10, right? But now they are not charging you the full price. They are charging you 900. You have 450, 270, 180. So you can see the proportion remain the same, but it's a smaller pie, right? The proportion is the same. It's a smaller pie. Does that make sense?
Yep.
So if in the midterm exams, there's a question like this, you will be able to do the calculation, right? Do the allocation. Does anyone have any question?
No.
No, this is
No?
quite clear.
Okay, good. Okay. Okay, so we're going to take a break. So because we are moving to step 5, okay? So we're going to take a break. So we'll come back in 10 minutes, okay? Come back in 10 minutes.
Oh, sorry, Prof, one more question.
Yes.
So this like weighted average allocation method, which method is that under? Like the 3 that you said? Is it still the residual one, or
yeah,
which
this
one
is? Yeah, very good question. This is the typical approach. When you have all the information available, okay, if you have, you know the standalone selling price for all the performance obligations, this is the way to go. So you first calculate the proportion, and then you apply the proportion against the total transaction price to get the allocated amount for each obligation. If in this example, right, in this example, we don't know what's the standalone selling price for the 3rd performance obligation, right? So we are not able to do the approach, right? The proportion approach, right? Therefore, we have a residual approach. So you just allocate. Under residual approach, you give the full amount of price, the standalone selling price. Whatever left over, you leave it for the unknown performance obligation.
Okay.
Yeah.
All right.
Okay. Good. Okay.
Yeah, thank you.
Take a break, and we come back in 10 minutes. I hope